Compounding. Compounding can occur in any investment, but its effects are particularly pronounced with daily leveraged ETFs. Why is this so? As discussed in the previous chapters, these ETFs seek to maintain a daily exposure of 3 times to the underlying benchmark index, and this 3-to-1 exposure ratio is reset or rebalanced every day. The daily rebalance is essential in order for the fund to achieve its daily goal, but can significantly increase or decrease an investor's exposure to the underlying index if they hold their position for periods greater than 1 day. These changes in exposure level over time can mean that the investor's return can be different, and sometimes significantly different, than 3 times the cumulative performance of the index. For the purposes of this section on compounding, we will focus exclusively on Jill's 3x leveraged bull ETF and how different market conditions affect her exposure over time. We'll be examining 3 different multi-day scenarios: when the market rises steadily, when the market declines steadily, when the market is flat but volatile. Keep in mind that all figures going forward are calculated before fees and expenses. For these hypothetical examples, the index value is 100 and the movements are set at 5 points per day, which is a large daily move. When markets rise steadily. It's Sunday night, and Jill has strong conviction that markets will swing upward tomorrow. On Monday morning, she buys $100 worth of a daily 3x leveraged bull ETF. Because of the fund's 3x leverage, Jill's total exposure to the index is actually $300. As it turns out, Jill is right, and by the market close on Monday, the index rises to 105 points, a 5% gain. Jill's $300 index exposure rises 5% to $315, giving her a $15 or 15% gain on her $100 investment. Her daily 3x leveraged bull ETF is now worth $115, and after the rebalance, her exposure to the index is $345. Although Jill's ETF's stated objective is to only provide daily leveraged results, Jill decides to hold on to her investment because she believes the index will move up again the next day. On Tuesday, Jill's instincts are proven right again, and the index moves up another 5 points from 105 to 110, a return of 4.76%. Jill's $115 position rises by 14.28% to $131.42. The index's total 2-day gain at this point is 10%. The upward index move after the rebalancing has caused positive compounding, and the cumulative return of the ETF is actually 31.4%, or 1.4% more than the index's cumulative gains times 3. So at the end of Tuesday, Jill's ETF is worth $131.42. On Wednesday, Jill continues to hold on to her daily 3x leveraged bull ETF. The market continues its rally, and her ETF's benchmark index rises another 5 points to 115. At the end of Wednesday, the index has risen 15% on the week, but the rebalancing, followed by favorable index moves, has caused positive compounding. Jill's 3-day return is actually 49.35%, greater than 300% of the 15% index move. Her ETF is now worth $149.35. Let's assume this pattern continues for the rest of the week. On Thursday, the index rises 5 more points to 120. The index has now risen a total of 20%. But the return on Jill's ETF is now significantly greater than 3 times that, 60%, at 68.83%. On Friday, the index again rises 5 points to 125, and Jill decides to close out her position. Her ETF is now worth $189.94. So while the index's total gain for the week is an impressive 25%, Jill's daily 3x leveraged bull ETF has returned significantly more than 3 times that, 75%. The daily rebalancing has increased her risk each day, and the subsequent upward index movements have caused positive compounding. As a result, the fund's accumulated week-long gain is actually 89.94%. While this positive return is certainly fortuitous for Jill, she understands that with each day's gain, her exposure to the index increases at an accelerated rate. In a short period of only 5 days, Jill's exposure to the market has nearly doubled as compared to her original investment. This level of exposure represents a high market risk. If for any reason the markets should experience a downturn, Jill stands to lose substantially more from a percentage standpoint than she would have if the downturn took place on day one. As a savvy investor, Jill recognizes her increased exposure and risk. She knows that even if she believes the positive trend will continue, it's probably prudent to sell a portion of her position to reduce her exposure, perhaps an amount equal to her gains for the week. Constant exposure level monitoring is highly recommended for all users of leveraged and inverse ETFs.